Hello friends, I welcome you to the next lecture on service concession arrangements. Accounting for service concession arrangements is done under Appendix A and B, which is attached to Ind AS 11. The internationals, we can say the authority is IFRIC 12 and SIC 29. So we are going to deal with service concession arrangements accounting. In the last lecture we have learned how we have to do accounting when the grantor gives us a financial asset, gives the operator financial asset in exchange for the services provided. In this particular lecture we are going to deal with a situation where the grantor, instead of giving us a financial asset in exchange for the services provided by the operator, if the grantor is going to give us an intangible asset, that is a license to charge the public for the services provided by the operator, then how to deal with it in the books of the operator is what we are going to discuss. Okay. Even before we go into this particular presentation, I would like to make a point very clear. See, in most of the service concession arrangements, operator entity will spend its own money, it will fund the construction of the infrastructure, operate it and maintain for the service concession period, and after the period is over, the asset would revert to the grantor. This is what happens normally. So the operator is going to spend his money for construction of the infrastructure. Now a question arises, can the operator capitalize that expenditure in his books of account? Can he show that infrastructure as an asset in his books for the concession period? The answer is no, because grantor is the person who can control the use of the asset. So if you read the agreement, grantor has control over use of the asset. Grantor will only grant access to the operator for operation and maintenance of the asset. So operator is getting access only for operation of the asset and maintenance. He does not have absolute control. Control is with the grantor. Only with the permission of the grantor, operator can enter the infrastructure, operate it and maintain it. If the grantor wants, he can stop the operator from accessing the infrastructure as well. Hence, operator cannot show that asset in his books of account as an item of property, plant, equipment, because he lacks control. Control is with the grantor. If the grantor wants, he can recognize it as an asset in his books of account, not the operator. Okay. So now in this lecture we are going to deal with a situation where the grantor, in exchange for the services provided by the operator, the grantor grants an intangible asset to the operator. The intangible asset is a license to charge the public for the services which they have received from the operator. That means the operator is receiving a license from the grantor. With this license I can charge the public for whatever use, whatever services they have utilized with the whatever services the public has utilized from the operator. So operator can now start charging the users for the services provided by him instead of the government. So he is going to recover whatever money he has invested on construction, operation and maintenance. He is going to recover by charging some fees from the users of that service. Okay. So how to account for that situation is what we are going to discuss in the form of an illustration. This illustration is picked up from the application guidance which was attached to IFRIC 12 and SIC 29. And actually there is no difference between what Appendix A, B say and IFRIC 12 and SIC 29 have to say. Okay. So let us take the example. Grantor gives operator an intangible asset. The terms of the service arrangement require an operator to construct a road completing construction within 2 years. So the service concession agreement requires the operator to complete the construction of the road within a period of 2 years. Then he also has to maintain and operate the road to a specified standard for a period of 8 years. So after construction is complete, it is the job of the operator to operate and maintain the road for a period of 8 years, from 3rd year to 10th year. The terms of the arrangement also require the operator to resurface the road. He has an obligation to even resurface the road when the original surface has deteriorated below a specified condition. So he also has to do some resurfacing of the road. The operator estimates that it will have to undertake resurfacing at the end of year 8 and it is not revenue generating. So operator knows that from year 3 up to year 8 the service is going to be used by the drivers, the road is going to be used by the drivers, and the quality of the road is going to deteriorate, and it will have the liability to do resurfacing of the road at the end of 8th year. For that he has to provide for some amount to meet the resurfacing obligation, and it is not revenue generating. He cannot expect any extra amount from the drivers for resurfacing of the road. Then arrangement ends at the end of year 10. Borrowing cost is 6.7%. So if the operator has borrowed money for this project, he is going to pay an interest of 6.7%. This is an assumption which we are making. Let us see the terms and conditions. Construction service. It has to be in construction service. It is provided in the year 1 and he has to spend, let us say, an amount of 500 crores on it. Construction service 2, which is provided in year 2, and the amount to be spent is 500 crores. So construction is covered in year 1 and year 2, he has to spend 500 and 500 crores in each year. Operating service per annum, from year 3 to year 10, he has to spend 10 crore for operating and maintaining the road. Road resurfacing, which has to be incurred at the end of 8th year, I have to spend estimated amount of 100 crore for getting the road resurfaced. And then tolls collected from drivers expected to remain constant. So the grantor has given the operator a license to collect toll charges from the, we can say the grantor has given the operator permission to set up toll gates, and where he can collect toll charges from the drivers who are going to use that road. And it is expected that the number of drivers, number of vehicles using the road will remain constant over a period of 3 to 10 years, that is 8 years, and we are expecting to collect every year 200 crore per annum as toll revenue. So this is the information given to us. How to do accounting for this is what we are going to discuss. Now, accounting for this kind of a situation is discussed in para 17 of appendix A to Ind AS 11. So see, let us see what para 17 has to say. The operator is granted an intangible asset. See, what is the operator doing? The operator is constructing the road in year 1 and year 2, and from year 3 the road is open for services. That means the drivers can start using the road. And from year 3 to year 10, the operator also has a responsibility of operating and maintaining the road for all these services provided. For construction service, for constructing the road in year 1 and year 2, the operator has spent 500 crore each year for the purpose of construction of the road. Okay. And in exchange, what is he getting? He is getting a license from the government to start collecting toll charges from the drivers. So what we have to think is the operator will assume that the construction service which he has provided is a consideration paid to acquire license from the government. So the license which he is getting, it has costed him the construction service. So he has to find out what is the fair value of the construction service, not the cost, fair value of the construction service. That will be considered as the cost of intangible asset acquired from the grantor. The intangible asset is licensed to charge toll charges from the public who are going to use the road. Okay, so this is the logic we are going to apply. So the construction service which I have provided, its fair value will be considered as cost of the intangible asset acquired, and this intangible asset will be amortized over its useful life. That is from year 3 to year 10. In that period, I can start getting benefits because of this intangible asset, that is a license to charge toll fees from the public, from the drivers. Okay. So the operator is granted an intangible asset. The intangible asset is a license to charge drivers toll charges. Construction service is the consideration paid to acquire the intangible asset. To get that license, I have provided construction services. Intangible asset is amortized over the period in which service is provided to the drivers. So I have to amortize that intangible asset over the period in which I am providing service to the drivers. During the construction period, borrowing cost is capitalized. So during year 1 and year 2, if any borrowing cost is incurred by the operator, then that will be considered as an expenditure to bring intangible asset into useful condition. So to get this license, I have to incur expenditure. If I have incurred borrowing cost for the purpose of getting this intangible asset ready, that borrowing cost can also be capitalized as part of cost of the asset. Toll collections are to be treated as revenue. Okay. So whatever toll collections I get, I am going to treat it as revenue. This is the accounting which is prescribed by para 17. See, here there is a logic. The operator is providing two services. One is construction service, he is constructing the road for the public, and second is he is also operating it and maintaining it. So he knows that when he constructs the road, if he is constructing the road for somebody else, he is going to get some profits. So the road construction service which he has provided to the contractor has to be measured at fair value. So he has to book some construction profit in his books, but he is not going to get the money for construction services. Once he operates and maintains the road, he is going to get every year toll charges from the public. So the toll charges will become revenue for him. But to get those toll charges, he has to get the license. To get the license, he has to complete the construction service. That is, he has to complete the construction of the road. Okay. Now let us see the cash flows which are associated with this particular project. Year 1 to 10. First year there are no receipts, but in the first year and in the second year, we are spending 500 crores on construction of the road. Borrowing cost incurred. First year there is no borrowing cost incurred because we are assuming that all cash flows take place at the end of the year. That means there has been no borrowing at the beginning of the year. This 500 crore which was spent in year 1 for the purpose of construction of the road, it is assumed that it is incurred at the end of the year. That is why there is no borrowing cost in year 1. Net cash flow for year 1 is negative 500. That means a borrowing of 500 has been done. That means you have borrowed money from a bank for the purpose of construction of the road. We are assuming that. Okay. Second year receipts are 0, but we have an opening borrowing of 500. On that, borrowing cost will be incurred in second year. So 500 crore is the construction cost incurred in the second year, 500 crore is incurred in first year, another 500 crore is incurred in second year. This 34 crore is the interest incurred on the cost which is incurred in the last year. So we had a negative cash flow of 500 in the last year, on that borrowing cost is 34. So by the end of second year, the negative cash flows, cumulative cash flows increased to 1034 crores. That means by the end of second year, you have a borrowing of 1034 crore on which you have to pay interest in the third year. Now, what happens to this borrowing cost which is incurred in the second year? It is an expenditure incurred to acquire intangible asset, that is a license to charge toll charges from the public. Hence, that will also be capitalized as part of cost of the intangible asset. Okay. Third year, we have started getting some receipts. We have started charging the drivers toll charges. We have got 200 crores as receipts. Contract cost to operate and maintain the road is 10 crore. Borrowing cost 69 crore is 6.7% of 1034 crore. So at the end of second year, the total borrowing was 1034. On that 6.7% interest, this is the borrowing cost for the current year. So we have a positive cash flow in year 3 of 121 crores, and cumulatively the borrowing amount has now reduced to only 913 crore. So in the beginning of year 4, again we have a receipt of 200. We have incurred 10 crore for operation and maintenance. Borrowing cost is now incurred on the opening balance of the borrowing. At the end of third year, the total borrowing was 913 crores. On that 6.7% is 61 crore. The net cash flow for year 4 is 129. Cumulative borrowing is now only 784 crore. That means by the end of 4 years, because some receipts have started coming, we have started repaying the loan and the borrowing amount has reduced. So by the end of 10th year, we'll see how the cash flows are going to occur. And only in the 10th year we have positive cumulative cash flows. That means we have repaid our borrowing and we have still some cash left. Okay. So this is how the cash flows are going to occur. In year 8, if you observe, we have incurred 110 crore. 110 crore is incurred for two things. One, 10 crore for operation and maintenance, and 100 crore for resurfacing obligation, to satisfy the resurfacing obligation. Now, how to deal with resurfacing obligation? According to Appendix A, we have to deal with resurfacing obligation in this situation based on the requirement of Ind AS 37. See, the logic is very simple. We know that we can start using the road, the drivers can start using the road from year 3 up to year 8. And year 8 there is a resurfacing obligation. That means the total period of time which has elapsed is 6 years. So the drivers are using the road in year 3, 4, 5, 6, 7 and 8. That means over a period of 6 years the road has been used, and in the 8th year, at the end of 8th year, we have to do the resurfacing. And it is assumed that over the contract period, the number of drivers using the road is going to remain constant. So we have to assume that the damage done in each year, year 3, 4, 5, 6, 7, 8 is going to be the same. So we now know that at the end of year 3 itself, we estimate that at the end of year 8, that is 5 years from now, from end of year 3 up to end of year 8, there are only 5 periods left. So in year 3 we know that by the end of year 8 we have to incur 100 crores for resurfacing of the road, and this 100 crore we have to incur because of the damage done in year 3, 4, 5, 6 and 7 and 8. So over a 6 year period we are going to do damage. That damage has to be rectified by the end of year 8. So for each year the damage is going to be 100 crore divided by 6. Every year damage is worth 17 crore. That means for the services provided to the users during year 3, 17 crore has to be spent at the end of year 8 for resurfacing. For the services provided in year 4, the damage which has been done to repair it, to resurface it, by the end of year 8 we have to spend another 17 crore. For the damage which is done in year 5, to repair that damage you have to spend 17 crore at the end of year 8. Similarly for all the remaining years as well. So for year 3, 4, 5, 6, 7 and 8, every year we have to spend 17 crore. Now for the damage done in year 3, we have to spend 17 crore at the end of year 8. We are not going to provide for that, we can say, expenditure which has to be incurred by the end of year 8, 17 crore, in the third year books of accounts now itself. So what we have to do is, we know that for the damage done in year 3, you have to spend 17 crore at the end of year 8. We are not going to provide for 17 crore now, we are going to provide for its present value. So in year 3, we will provide for the obligation, 17 crore would be discounted to its present value. There is 5 years left from the end of year 3 up to the end of year 8. There are only 5 periods left, 5 years left. So we have to discount it for 5 years and we have to find out the present value of the obligation for the damage done in year 3. So I have just shown here For the damages done in each year, we have to spend 17 crore. All of them total to 100 crore, which have to be spent at the end of 8 years. So we are saying out of 100 crore, the damage for year 3 is 17, for each year it is 17. But this expenditure has to be incurred by the end of 8th year. So damage is done in year 3, but expenditure has to be done at the end of year 8. We have to discount the amount to its present value. So if I discount it, number of years left is 5, 4, 3, 2, 1 and 0. So I have to discount 17 crores for 5 periods at 6% rate of interest. That is a risk adjusted discount rate, which has to be used as per Ind AS 37. So we have to use the risk adjusted discount rate for finding out the present value as per the requirements of Ind AS 37. And I find that the present value of 17 crore today is 12 crore. That means for the damage done in year 3, the expenditure which has to be incurred at the end of year 8, its present value today it is only 12 crore. So in year 3 we have to provide for 12 crore. And as the expenditure reaches one period nearer the date of settlement, the provision is automatically going to increase because of unwinding of discount. For year 4, again we know that for the damage done in year 4, we have to spend 17 crore at the end of year 8. We are not going to provide for 17 crores in year 4. We have to find the present value of the expenditure which has to be incurred at the end of year 8 for the damage done in year 4 and provide for the present value. 17 crore has to be incurred at the end of 8 year, and it is 4 periods away from now. That means you have to discount it and we find that the present value is 13 crore. Similarly, for each year, whatever damage has been done, to repair the damage, whatever amount has to be incurred by the end of 8th year, we have to find the present value, and we have found out the present value of the amounts. Okay. So now let us see how the obligation account will proceed. So let us see how the obligation account is going to proceed. Year 1 and year 2, the road is under construction, so there is no obligation to resurface. In year 1, year 2, the road has not been used at all, so there is no damage done to the road in year 1 and year 2. But in year 3, the drivers have started using the road, the operator starts getting some revenue as well. So damage is done in year 3. We know that for the damage done in year 3, we have to spend 17 crore by the end of year 8. But we are not going to provide for 17 crore now, we have to provide for its present value. So in year 3, if you observe, I have prepared the obligation account here. Opening balance of the obligation, unwinding of discount, that is finance charges, current year provision, you get the closing balance. So opening balance, add finance charges, add current year cost, you will get the closing balance. So year 1, year 3 opening balance is 0, there is no unwinding of discount, but current year cost is 12. What is this 12? This is present value of 17 crore to be incurred at the end of 8th year. That 17 crore is the damage done during the year 3. So I found its present value, it is 12 crore. So closing balance of the obligation is 12 crore. Now for 4th year, opening balance of the obligation is 12 crore. This was provided already in the year 3. Now finance charges. On 12 crore you have to provide 6%. I have rounded off to the nearest whole number. So this is the finance charge on this opening balance of the provision. And this is the current year provision. For the damage done in year 4, we have to spend 17 crore at the end of year 8. So we have to provide for that in year 4 itself. So you have to find the present value of the 17 crore for 4 periods. You find that it is 13. So if you add opening balance, unwinding of discount and the current year provision, you get the closing balance of the provision. In 5th year, 26 is the opening balance of the provision, interest cost, unwinding of discount. See, we are reaching one period nearer to the date of settlement. So the obligation amount has to increase. So that is the unwinding of discount which is happening here. And in year 5 also damage is done, which has to be rectified by end of year 8 by spending 17 crore. We are not going to provide entire 17 crore in year 5, we are going to provide for its present value. So I have found the present value 14 crore which is added. So now the obligation account increases to 42. So by the end of 8th year, the obligation account shows a balance of 100 crore. This can be used for the purpose of resurfacing obligations. So we can use this 100 crore which is available in the provision account for the purpose of doing resurfacing of the road. And this finance cost is going to be debited to profit and loss account, and the current year provisions are going to be debited to the respective P&L accounts. Now let us see the amortization of intangible asset. See, we all know that for the construction service which we have provided to the grantor, the grantor has given us a license to start collecting toll charges from the drivers. So to collect the toll charges from the driver, we have incurred some expenditure on construction services, and I have received an intangible asset called as a license. So for getting toll charges, I have acquired an intangible asset. This intangible asset has to be matched to the revenue which is being generated from the intangible asset. Okay. So at what value to show that intangible asset? See, Ind AS 38, which deals with intangible assets, clearly says intangible asset has to be incorporated in our books of account at its fair value. So here I have provided construction services, I have to find out what is the fair value of the construction service. That is the consideration paid to acquire the intangible asset. So let us see how it is calculated. Construction service in year 1, fair value of the service provided to acquire that license, 500 crore plus 5%, 525 crore. That means in year 1 I can show 525 as construction revenue and 500 as construction cost. 25 will automatically get booked as profit, or I can pass an entry like this: intangible asset account or to contract revenue. Intangible asset 525, contract revenue 525, and will correspondingly match construction cost of 500. Automatically profit of 25 will get booked. In year 2 again, I have provided again construction service. I have spent 500 crores. Fair value of the service provided is 500 plus 5%, 525. Again in year 2 I will pass an entry: intangible asset account or to contract revenue 525. Contract cost will be debited to P&L account, 25 crore will get booked as profit. So now I have intangible asset 525 plus 525, 1050. But in year 2 I have incurred borrowing cost on expenditure incurred in year 1. So in year 1 which I have, whatever borrowing I have done, on that I have incurred some interest cost that will also be capitalized as part of cost of the intangible asset. So in year 1 I am going to capitalize some borrowing cost of 34. So the total intangible asset is 1084. And I have to amortize this 1084 over a period of 8 years, because I will start getting benefit from this intangible asset from year 3 up to year 10. So the intangible asset has to be amortized over its useful life. Useful life is only 8 years now. So 1084 by 8, I have to book every year 135 as amortization charge. Okay, so that is how I deal with the intangible asset. Next, let us see the P&L account effect. In each year, year 1 to 10, revenue. First year 525, this is for construction service. Second year also I got some revenue, that is for construction service. So in year 1 I show a revenue of 525, corresponding costs are booked. Here I will pass entry: intangible asset to revenue, intangible asset to revenue, construction cost to cash, construction cost to cash, 25 will get booked as profit. And the intangible asset which is capitalized will be amortized over a period of 8 years, from year 3 to year 10. From 3rd year to 10th year I am getting some toll charges which I am showing as revenue. Construction contract costs which I have incurred, so I have shown all the costs which I have incurred, 500 and every year 10 crores on operation and maintenance. Borrowing cost incurred for construction services, I have included them here. The borrowing cost which was incurred in year 2 has been capitalized as part of cost of the intangible asset. Resurfacing obligation, every year we have provided for present value of 17 crore. In year 3 we have provided present value of 17 crore. In year 4 we have provided the present value of 17 crore. 17 crore is the value of damage done in each year. In year 5 I have provided for present value of 17 crore, that is the value of damage done in year 5. So this is the present value of the obligation which is debited in the that year's P&L account. Then this is the unwinding of discount on the provision. So that is what we are debiting here. And then we have the amortization of intangible asset which is debited to P&L account. And the last column is net profits. So this is how we are going to deal with this kind of a situation when the grantor gives you an intangible asset for the services provided.